Low oil prices are affecting E&P and oil and gas service companies, or so says the Dallas Fed Energy Survey. Next on the Energy Newsbeat Daily Standup. OPEC Plus pumps up quota, but can they make these new quotas? So this is very interesting. So we all know that on Saturday, OPEC Plus was meeting to continue their production increases, and the thought was 411,000 barrels. That was what our per day adding every single month. That was everybody thought. But what they did in a virtual meeting is actually announce a heftier production increase of around 548,000 barrels per day for August 2025. And this decision was really led by what we were kind of considering the voluntary eight: Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, Algeria, and Oman. Super interesting. I think people had a feeling this was a possibility in one of the months. I don't necessarily think people were expecting it this month, but I think there's a few things they're looking at. One they point out in this article is, low global inventories. Global inventories are low, and it's interesting because even being in an oversupplied market, we find ourselves in the scenario where global inventories are at near 2 to 3 year lows, which is interesting. And I think that has the majority to do with it. Again, I've said this from day one. I don't think that this move by OPEC Plus is necessarily to regain market share from the United States, Brazil, or any other country that they feel like is gaining too much power. It really has more to do with either punishing their own internal members, specifically Kazakhstan. This article points out here that in June, Kazakhstan output surged about 7.5% to 1.8 million barrels per day, which is well above its quota of 1.5 million barrels, while Iraq has also done the same thing, continued to blow up their cuts. And so I really think this is more about trying to punish their internal members and, on a secondly, deal with what is actually a slightly undersupplied or low global inventory demand. Now, obviously, that's going to change. We're in an oversupplied market and have been, they say, for the past 6 months. Those global inventories will begin to rise. So the question is, what sort of goes from here? So this hike in August brings OPEC a lot closer to fulfilling its 2.2 million barrel per day voluntary cut. Now remember, that's on top of a cut of already 3.66 3.66 million barrels per day. So there's in total about 5.8 million barrels off the market. They're just bringing back the 2.2, which was these voluntary cuts. They'll probably do that and be able to get it done a little bit closer. But I think it kind of goes to show you how at least the rest of the world is thinking about this. They're not necessarily as worried about lower oil prices. I think what they're worried about is the low global inventories. And if anything with this Russia-Ukraine war has shown us, it's that access to energy is critical. And I think with some of the stuff that you've then seen in the Gulf going on right now between Israel and Iran, I think a lot of these countries are saying, hey, we got to solve this low global inventory thing, tap into this oversupplied market. And I think that's what we're seeing here. Let's jump over now. Big beautiful bill represents the energy policy playing field, a new era for oil, gas, and nuclear. We've been following this now for 2 weeks. It was made official July 3rd, 2025. President Donald Trump went ahead and signed the One Big Beautiful Bill, which was literally actually called One Big Beautiful Bill Act, the OBBBA, which is unbelievable. A lot of this analysis we're pulling out is from good friend of the show, David Blackman, in his writings with the Daily Caller. For one, I think there's some fragility in this beautiful. From a high level, a lot of House Republicans weren't necessarily happy with a lot of the amendments that made it into the Senate. Vice President J.D. Vance had to come back to the Senate and cast a tie-breaking vote, which is interesting. I think there's two things in here to point out. There's mainly, from an oil and gas perspective, the main thing to point out is the regulatory reform that comes in here. So basically, the idea is that now we're going to be able to streamline the permitting process for a huge amount of energy. And remember, it's not just the drilling of the wells that matters in the whole energy production process. We have to talk about how is this oil and this energy actually being created to electricity. And that's where a lot of this regulatory change comes in. If you're in the data center business, if you're in the power business, this is a huge bill for you because it's going to allow you to more rapidly permit these things. The quote out of API CEO Mike Summers, or the American Petroleum Institute, he called the OBBBA, quote, a historic legislation that ushers in a new era of energy dominance. He's going to say that regardless. It also, this follows up on Trump's attempting to become, drill baby drill is what he thinks. So the OBBB really follows what we did with what he did with the National Petroleum Reserve in Alaska, which opened up about 13 million acres for leasing. I do think there is this, as we'll get to in the Dallas Fed survey. I think there's this, what the White House and administration are saying versus I think what some of the boots on the ground saying. But there was a big win for nuclear in this. The FTI Consulting, an oil and energy consulting firm, called basically one of the biggest winners in this whole bill from an energy perspective, nuclear power. And basically it comes down to regulation. It supports also, this legislation has language in there that supports the development of next generation nuclear technology, specifically stuff that Stu talks about, which are these small modular reactors, which, I mean, again, are critical if you are going to create these, if you're going to create, so if you need a data center, you're probably going to need at some point nuclear on this, because there's so much power associated with it. Coal was mentioned a little bit. They really didn't put anything specifically in it for coal. I think in the press conference that followed, you saw a lot of people talking specifically about how we're going to end the war on coal. Chris Wright, Secretary Wright, said that. So, the real argument is it'll bought everything, a smorgasbord from an energy mix. Obviously, if you're in the wind and solar business, you saw that those subsidies were stripped out. Now, this was a interesting thing. So I'll kind of just read you a little bit of what David Blackman wrote. A deal brokered by Senate Majority Leader John Thune and Alaska Senator Lisa Murkowski often softened the original timeline for the rollback of those wind and solar subsidies from the IRA, allowing for projects that commence construction by July 4th, 2026 to retain incentives rather than requiring them to be operational by 2027. So what you can imagine is there's going to be this huge rush between now and 2027 to start a project so that you can maintain those subsidies. I think obviously this will dampen long-term wind growth, but I think you're going to see a lot of projects get quote unquote kicked off, have a little bit of money spent, so they still qualify for these subsidies. I think all in all, I think this is what David Blackman says, and I would echo this sentiment. This is a bold reset for American energy. Here's his quote: "Second chances like this do not come often. If these great industries fail to grab this brass ring and run with it, it may never come again. For oil, gas, nuclear, the OBBA is not just a policy reason, it's a mandate to lead American into the new era of energy dominance." It's a really incredible, again, reset and opportunity. Stu mentions here in this article he's going to be lining up some nuclear interviews on the podcast, so it'll be very interesting to see. But a highly controversial bill. I think it again, with the IRA wind and solar subsidies, I would have maybe liked to see them phase out completely by 2027. I think this compromise has a lot more wiggle room. It'll be interesting to see how it all plays out. Let's jump over and quickly cover oil and gas prices. Before we do that, guys, we're going to quickly pay the bills. As always, thank you for checking us out here. World's greatest website, www.energynewsbeat.com. Stu and the team do a tremendous job keeping that website up to speed. Everything you need to know to be in the tip of the spear when it comes to the energy and the oil and gas business. Go ahead and hit the description below for all links to the timestamps, links to the articles. You can also hit the link to our Substack, theenergynewsbeat.substack.com. It's really the best place to support the show. We drop new articles every single day that you can only find on Substack, which is really an analysis of what we're seeing in the broader industry ecosystem. Obviously, Newsbeat is going to have, our website is going to have all of the real-time news. It's a great place to stay up to speed. But if you want to know what this means to you, our Substack, theenergynewsbeat.substack, is a great place. Please subscribe to that. It's one of the best ways to support the show. Feel free to sign up for a paid subscription. You'll have access to our entire archive of articles, as well as getting some custom stuff from students. So highly recommend checking that out. Shout out to Reese Energy Consulting for supporting the show. We really appreciate their support, and we love Reese Energy Consulting. They do one of the best jobs in the midstream space in terms of consulting around it. They've got clients that range from two guys in a garage all the way up to the largest publicly traded company. So if you're wondering if they're a right fit for you, the answer is yes. If you're in the upstream space and you're not working with a marketing company, call up Reese Energy Consulting. They're going to save you money on your first purchaser contracts. If you're in the midstream space and need some outside support on any project projects you're doing, they have the resources, the talent, and the know-how to get it done. ReeseEnergyConsulting.com. Tell them Energy Newsbeat sent you, and they'll give you a massive 3,000% discount. That's a joke, but they might give you a little something. We appreciate their support. And finally, guys, if you're wondering if it's right to add oil and gas to your portfolio, we have a survey, investinOil.energynewsbeat.com, our oil and gas portfolio survey. Fill it out. Based upon your answers, we'll send you a bunch of information on what it looks like to invest in oil and gas, the differences between oil, gas, minerals, and if you qualify, we will send you and point you in the right direction of some other people that you can talk to. So investinOil.energynewsbeat.com if you are thinking of adding oil and gas to your portfolio. But let's go ahead and run down blind indices here. S&P 500 was up about 0.8 of a percentage point. NASDAQ was up about a full percentage point. 2 and 10-year yields spiked tremendously. 2-year yields up 2.5 percentage points. 10-year yield up 1.5 percentage points. A dollar index has fallen, continues to fall down about a 1/10 of a percentage point, which has just continued to fall to astronomical lows relative to where it's always been. Bitcoin sitting at about $109,000. Crude oil lost about 7/10 of a percentage point on Friday. 66.50 for WTI. Brent oil was basically flat, 68.05. Natural gas down to $3.38. That's about 2 cents off that index. XOP, which is our EMP securities contract, basically flat. You're looking at 129.17. So basically flat. I think the big reason why there was some softening, there was some softening on oil prices, I think has a lot to do with the perspective, which on Friday, which was the perspective cuts that were coming from OPEC. There was a little bit of a wind on Friday that we might see something bigger than 411. I think people were skeptical of that, but I think the market slightly reacted a little bit to that, or at least priced in that sentiment a little bit. So it'll be interesting to see here when prices open this afternoon as I record this, mid-afternoon here on Sunday the 6th, what happens from a pricing perspective. I think the other thing that was interesting to see, we saw rig counts drop by 8 down to 534. So rig counts begin to fall off the map. We saw frac count spread drop by another 3. So now we're down to 176 frac regs moving. But really the one of my favorite times of the year, the Dallas Fed Energy Survey, it dropped for the second quarter, which is basically a look at what's the oil and gas. They basically do an interview of over 75 different oil and gas companies, both big and small, and then aggregate the data and have a bunch of comments. So we'll go ahead and I'll kind of read some of the headlines and we'll dive into some interesting stuff I saw. The oil production index, I think that's the big thing that people talk about, fell from 5.6 to negative 8.9. So an unbelievable swing in the second quarter. Natural gas production index also did turn negative, declining from 4.8 to negative 4.5. This is another big one. The oilfield services input cost index rose from 30.9 to 40.0. Pretty unbelievable. For E&P, the finding, and this is interesting, the find and development cost actually fell from 17.1 to 11.4, which is actually great. We saw lease operating expense index drop from 38.7 to 28.1, which is fairly good relative to where we see. I love this top line. Oilfield services reported a modest deterioration in nearly all indicators. Equipment utilization remained unchanged at about negative 4.6. The operating margin increased from negative 21.5 to negative 33.4, indicating that the margins continue to compress at an extremely fast rate. Prices received for services turned negative. They were at 7.1 last quarter, and now they're at negative 17.7. Some other interesting things here. We've got the average WTI crude. Okay, so basically most people thought that WTI was going to average $68 per barrel at the end of 2025. That range was between about 50 to 85. When you increase to a little longer term of a time frame, on average, people were saying about $72 a barrel and about 77 5 years from now. On the gas side, $3.66 by the end of 25. 2 years from now, $4.12, and in 5 years, $4.50. I'm not sure if I necessarily believe that. To give for a sort of a reference point, WTI averaged about $69.81 per barrel during the survey collected, and Henry Hub was about $3.30. Yeah, most people, you kind of see that nice bell curve. I'd highly recommend going and checking out these charts here. We also did see, I love this There was a bunch of special questions that they asked E&P firms. One of them being how's the number of wells your firm expected to drill in 2025 changed since the start of the year? Basically, the highest bucket was no change at 35%. A significantly decreased was actually the second highest at 25%. Slightly decreased was at 20%, and then at 15, it was slightly increased, and about 2.5% slightly increased. So, or increased significantly, which is unbelievable. There's a bunch of stuff on tariffs. Tariffs have affected all different operators differently. I think if you're a large operator, you're able to get away with it a little bit more. If you're a smaller operator, you're not. You can kind of look at that of the response of changes. So small E&Ps were basically scattered between no change and above 10%, with 13 of the E&Ps or 13 small operators reporting a 10% increase, which is unbelievable. Basically 23, which is unbelievable. And large E&Ps saw nobody reported no increases above 6%. So all of the large E&Ps, whatever you call large E&P, a firm that produced 10,000 barrels or more a day, they saw no more than 6% increase, which again goes to show you those economics of scale. There's a bunch of questions on WTI. I want to get down specifically and cover some of the E&P. So now these are comments from survey respondents. So I'll read you what they say here. Survey participants are given the opportunity to submit comments on current issues that may be affecting their businesses. Some comments have been edited for grammar and clarity. Comments from the special questions can be found, blah, blah, blah. All right, so here's a couple of what I found of the interesting quotes. The Liberation Day chaos and tariff antics have harmed the domestic energy industry. Drill, baby, drill will not happen with this level of volatility. Companies will continue to lay down rigs and frac spreads will rise. There is constant noise coming from the administration saying $50 per barrel is the target. Everyone should understand that 50 oil is not sustainable. It needs to be mid 60s. There is too much uncertainty in the market right now. And I just have to jump in there. I mean, trust me, I'm a Trump supporter myself. I think it's very clear where I stand on that. But I think if Trump was saying he was going to drive oil prices down to $55 a barrel while he was while he was in the election circuit. I mean, before he was elected, while he was campaigning. So to think that this is a shock of where Trump stands when it comes to oil prices, I think you're kidding yourself. Yes, the regulatory environment I think is a lot better, but the regulatory environment really wasn't affecting the upstream E&P business. What really affects them is prices. And if really prices are going to get down to the $50 range, as this comment points out, it's not going to be sustainable. It's got to be in that $65 range at least to be able to get that. Political turmoil is not beneficial. We are dealing with warring bureaucracies, each trying to exert their specific agendas and effectively prevent progress. So this is interesting. Here's from a smaller operator. Service costs are low and wells are very economic, but there are inventory challenges for small operators like us. And now I think we get into a podcast that I did a couple weeks ago with Bennett Williams that we're in the process of finishing up, where when you actually look at the challenges that E&Ps are facing, he makes a great argument in the piece that we talked about, which was it's actually geologic, it's inventory problems. If the rock quality is not good, well, it doesn't matter where prices are. It doesn't matter. It does matter where prices are, I guess, but geology drives the economics of a well. And so if you're a small operator and you don't have much inventory, it can be a real hard. I think there's this other interesting quote. We are spending way too much time and resources on trying to predict the price of oil. We dropped our rig count 50%. Also, suppliers are being squeezed and there's concern that some of our vendors will not survive. Interesting. Another interesting comment here. If the Federal Reserve would lower interest rates, the oil patch would see a jump as the economy recovers to a higher level. Interest rates are holding the oil industry and the economy as a whole back. Interesting. Here's some oil and gas service firms quotes. E&P customers are delaying activity due to steel tariffs. Our biggest issues are the steel tariffs we are absorbing as an oilfield service company. Our customers are refusing to help absorb these costs. E&Ps continue to speak out of both sides of their mouths. They talk about partnerships, but are treating their vendors like second-class citizens, pushing OFS to unsustainable margins. This is a very, very interesting quote, and I have to agree with this service company. I mean, there is huge talk in the business about, oh, we're partners with our vendors, we're partners with them, but it's always the E&Ps going to the vendors asking for discounts rather than helping absorb some of the costs themselves. I think it's really interesting, this sentiment, and I think this is a very, very interesting quote, which I think this is another interesting quote. While the overall rig count has dropped, we are seeing more of that drop coming from the larger operators, and with that, a chance for smaller operators to pick up rigs at better prices. In our market, smaller operators, we feel like this environment provides opportunity. We're hopeful that more carve-outs from last year's M&A bonanza will continue to create deals for the smaller and more nimble operators to prove up non-core divestitures. Very interesting. One, to quote, the price of oil is an issue affecting our business. Well, I could have told you that. So very, very interesting. I love the Dallas Fed survey. Go ahead and it's like 9 pages. So I'd highly recommend going, hitting the link in the description below to check it out. But that's really all I've got, guys. Stu was out on assignment today, so thank you for sticking with me on a solo show. We will be back in the chair tomorrow night. We appreciate everybody checking us out here on the world's greatest daily show, Energy Newsbeat Daily Standup. For Stuart Turley, I'm Michael Tanner. We'll see you tomorrow, folks.